Good day, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. Today is Friday. It's January 28th. It is the last, I'm not sure. I think Monday's the last trading day of the month. I'm not positive. We'll have to check that. But the markets are going to open up in a little bit more than an hour and a half, about an hour and 36 minutes. As you can see here, we are down quite a bit. I mean, look at this. The Dow's down 380 points. Nasdaq's down over 100 points. We are definitely beyond random today. Now, I want to show you something interesting. If you notice the trading action over the last few days, it's been very, 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 very choppy. But we still haven't been able to take out this bottom, which is at the 33,000 level. So if we could stay above this level for the next few days, and if we can rally based on the Apple news that I'm going to talk about in a minute, the markets could be stabilizing. I know things are really choppy and it doesn't look like we're moving anywhere, and we haven't. I mean, this is like a roller coaster, and a big roller coaster. Look at this, 34,400, 33,000, 1,500 point move in a day. So we got to kind of take the current trading action and the current volatility with a grain of salt. When the market's moving 1,500 points a day, 370 point sell-off is not that big of a deal. By the way, I know a lot of you have been wanting to get to reach out to me. Sorry to interrupt you mid-video, but if you'd like to reach out to me, if you have questions, comments, concerns, feedback, if you want to say thank you for me posting these long videos every morning, support@marketgeeks.com, support@marketgeeks.com. I want to hear from you, especially in this type of crazy market. So we're again abutting the 200-day moving average, and if we could get a little bit above the moving average, we could be in a lot better position. Now, I actually thought the market was going to be really, really strong today on the open because Apple, and remember, Apple is the biggest company in the world, and it has about 12% market cap, and look at how much it's up. It was up quite a bit more pre-open, and it can't sustain the market, and the numbers were really, really good. Came out quarterly at $2.10, better than $1.89, compares to $1.68. So they're doing really, really good. Earnings surprise of 11.11%. That's very, very, very solid. And they posted revenue of $123 billion for the quarter compared to $111 billion. So the numbers are solid. The stock, let me show you the stock. I like the stock, and we're holding the stock in one of our portfolios right now. But as you could see here over a 3-month period, the stock hasn't broken the 200-day moving average. It's really outperforming the Dow. And it looks to me like it's ready to move higher. So I'm liking Apple, but I'd like to see it go above the 170 level. If I could see Apple go above the 170 level and stay there, I'll be a happy camper. And remember, the market capitalization on the stock is just amazing, and I mean amazing. Looking at the bond market, we've been just as choppy as we've been with stocks. I'm very glad that I didn't buy bonds and hold them for a long time here because we would have been negative. Just nothing going on with bonds. And that's telling us the market's really confused about the future of interest rates. But I will say this, we haven't been going down since the 18th of this month. And we've been going higher, a little bit higher, but not lower. Now remember, when bonds go higher, that means interest rates are going lower. So even though the market is whacked out over interest rates, the bond market is building a support level around here. And put the call ratio and all that stuff is confirming that, as I will show you in a minute. Let me just go here real quick. Oops. Morning fat finger error. Sorry about that, guys. So as you can see here, we are continuously in the oversold, in the overbought. What am I saying? In the overbought, this is overbought here, but it's oversold in terms of the market because this goes up when the market breaks down and peaks out. So we're still near 1, and as you can see here, the trend has been moving higher, and the highs here have been moving higher as well. That means the market's getting more and more bearish. But again, it turns around when it gets to these levels. So I'm actually expecting these levels to cool off and break down when the market breaks above the 200-day moving average again. Now, I showed you this yesterday, and I'm going to show you this again. The number of stocks trading above the 50-day moving average, overall stocks, is really, really low right now, and it's very hard for us to break these levels. So in my opinion, the market is going to start moving higher, and this is a major shakeout. I'm expecting higher prices. Also, if you notice, market's been gyrating, but look at volatility. Let me show you a better view. It's going a little bit higher, but it's not doing this from this point on. I mean, it's just a little bit higher. So I think I imagine you're riding a horse that needs to be trained, that's never had anybody riding it, and you're training it, and it's just trying to throw you off, or you're riding a bull and it's trying to throw you off. That's what the market feels like right now. It doesn't feel like we're going into a bear market. It feels like this volatility that we're seeing is trying to shake everyone out before the market moves higher, and that's what it feels like. Again, we're still clustering around this 200-day moving average line, and we're not really breaking further down, and volatility is just amazing. So to me, that looks like we could be near the bottom. Now, today we've got personal income, which is going to be an important report, and we've got employment cost index and consumer sentiment. Let me talk a little bit about global economy and fill you in on all of these things. So major global stock market fell on Friday ahead of U.S. employment. That might influence Federal Reserve decision. I don't think it will at all. Wall Street were mixed Thursday after U.S. stocks declined for a third day as investors tried to figure out quickly the Fed might raise rates. How the Fed may raise rates. Inflation spiked to a 39-year high. The employment cost index that's coming out today is expected to show price that American labor rose by about 1.2%. That'll be very, very interesting during the final 3 months or the last quarter of the year, and it'll give us a good gauge of how labor prices are rising in comparison to wages and to independent contractors and to other costs, because it's very interesting to track inflation similarly. On Thursday, the S&P fell for a third day, losing 0.5. Official U.S. economy grew 5.7%, the strongest growth since '84, 7.2 jump. So we are moving in the right direction. In terms of growth, index is within 10 points of entering the correction, and Hong Kong economy grew 6.4%, and they're still tightening controls from COVID. The U.S. Stock market, folks, is on a roller coaster, and you did not need me to show you that. Now, again, if we look at our sector analysis, you'll see that we don't have fragmentation between technology and consumer discretionary. Energy, consumer staples, utilities, the markets, to me, look like they're ready to go higher from this point on, and I think they will. Also, if you look at the SPY, look at these RSI levels. They're real low right now. So the market really does need to jump, and it's not just the SPY, it's the QQQ as well. So let me show you the same thing. Look at that. Deeply oversold. And also look at the semiconductor index. Deeply oversold. So things look to me internally and from a market perspective like they're going to turn around. Market internals, volatility, the fragmentation, it all looks bullish. And also, Apple earnings were solid. Microsoft earnings were super solid. They were not negative. The stock went up when the earnings date hit. So in scheme of the big picture, things are improving. The Fed data is improving. Things are improving, and I think we're going to bottom out the next few days and go higher. And if we go lower, I think the Fed is going to revise their statement. Now, we took some trades this week. Believe it or not, we actually made money on 2 trades, even in this economy. We went long Tyson Foods right around here, got out yesterday right around here, entered here, exited here a day and a half later for a nice little snippy 18% profit in our sniper program. Before that, we got into a IP short. This is a short trade. The stock, we shorted the stock on the 24th. What is that? Or we got out of the stock on the 24th. Sorry, we got into the stock on the 14th, right here. And we got out of it on the 24th, right here. And it's still just a little bit below that price level right now. And I think it's going to cool off some more. But this one, we made 20.37%. In here, out here, held the trade for, let's see here. How long did we hold this trade for? We held this trade for 10 days. Not really that bad, a little bit less than 10 days. So a little over 20% here and a little over 18% on TSN. And those are the trades that we won on this week. You got to be very quick to take profits right now. This is not a position trader's market. And as far as next week is concerned, I think we're going to start seeing, let me just show you this. I think we're going to start seeing technology and consumer discretionary start little by little going higher. So I think that's what's going to happen. And I think next week, the bond market, let me show you the bond market here. I think the stock market is going to go higher, and I think the bond market is going to break up from this level and hit the 200-day moving average and start moving a little bit higher. I don't think rates are going to go much higher than they are right now, and I think this is too much too soon. I mean, this is 10% of the bond market in about 7 weeks, so I don't think there's that much more to go. Now, before I let you go, so don't take big positions. Be very, very defensive. Let the market show its hand. Wait and get a worse price. Wait for it to go above the 200-day moving average. You'll get a worse price, but you'll have a better indication and a better probability of success, because then you'll have a confirmation that the market is going down. So don't try to be greedy right now and buy the lows unless you plan on holding for a long time, because the level of uncertainty is really strong right now. And again, if you want to ask me questions, I'm around. I know people are panicking. Support at marketgeeks.com. Now, support at marketgeeks.com. Sorry. Now, I've got something really important to tell you. This is good stuff. We've been testing a new payment plan for our members so we can offer them valuable trades without a contemplating price tag. Let's just say it's been a hit. Traders have been able to get their feet wet in the markets all with a bang for less than $1. And just recently, we've seen wins like 28%, 32%, even 104%. Traders that joined this elite team right away could get their first trade as early as this week. Click on the link below to view the pay-as-you-go membership. I did this so everybody can join, no matter how much money you've got, because I know money's tight right now with these crazy markets. Follow the link below. Check it out. You're going to love this. You are going to be in love with this program, I promise you. And next week, we've got a lot of threats, biggest opportunities for next week. Don't miss out. You don't want to miss these videos right now. The markets are really moving and you need to stay on top of them. It looks like things are bottoming out. Volatility is really high. That typically is a recipe for consolidation and a move higher. But we got to be patient and we got to wait to break above the 200-day moving average. I'll see you guys on Monday, and I hope you send me some emails over the weekend. Support at marketgeeks.com. Bye.